Good afternoon, everybody. This is week 2 of Commodity Intelligence weekly report. Just a quick summary of the week's going on. This week we're going to focus on inventory and Capex and what it means to the cycle. Everyone's, of course, aware of the concept of the cycle. For us, the expansion phase began in around Easter 2016. We really got going tail end of 2017, very early last year. By midsummer last year, we were in Capex mode, expansion mode, and I think the trade war has foreshortened the cycle, and we've got a classic big slowdown going on. So I'm going to explain what's going on right now. First point to make is Capex really did surge last year. I just looked at the miners here. Miners was spending more money. The first rise in expenditure since 2013. Bottom of the screen here is the rig count. You can see the rig count rose steadily from 2016, basically crossed replacement levels sometime late 2017, and by the middle of last year we were running at about 2 million barrels of oil of added shale production. So, what happened? Basically the trade war. To put it simply, what happened is that as the trade war developed, OECD retailers bought enormous amount of goods in advance of the trade tariffs. So this gave sort of a bit of an artificial lift to say the end of the second quarter last year, but by the fourth quarter, the inventory pipeline in the OECD was stuffed, and we were reporting a large inventory in the West and a considerable slowdown in activity in China. And you can see the slowdown in activity here. The red line is basically the tariff goods orders, and we've seen a whole set of data out of China that looks like this. Just notice on the side that China's resorting to its foo economy and stimulating like crazy the other side to prevent the very large double-digit slowdown in the coastal economy showing through. You can see the inventory excess in the West. Retailers in the US were loaded up on pre-tariff goods. They ran out of space, so they began to rent containers and rent port space to store their excess inventory. It's a considerable number. So the last time this happened, the 2008 slowdown, it's estimated that we had about $116 billion of excess inventory in the US economy. I don't see why the number should be that different this time. The result, I'm afraid, is a very nasty downturn because, unfortunately, last year's Capex is this year's supply. We had the big Capex surge last year. We're just now seeing the supply arrive. Obviously, you start spending the money on your mine or your oil well middle of last year. You turn on the oil well when you finish the Capex, so that means you get the supply now. Last year's demand peak is unfortunately this year's inventory. That means you've got a very, very subdued real demand as far as the resource sector is seeing, and that's a very big slowdown. I think the market is being far too speedy about this because obviously you've seen this big slowdown, prices have reacted, and the market wants to buy the sector again. I think it's going to take a little longer than people expect. You've got the contracting impact, i.e., when you, for example, in the oil industry, we've got 2 million barrels per day of pipelines coming out of Texas this year. As those are all contracted, oil wells will be turned on into those pipes as they turn on. So it's going to take a little bit of time to sort this out. With that, thank you very much, and I'll close the week's
Mm.